Hello everybody and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. For those of you who don't know me, my name is Scott Plaskett. I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. On today's episode, I invited Mike Flux, Senior Vice President and Portfolio Manager at Connor Clark & Lund Private Capital, to chat about their investment outlook. We also discussed how to interpret the current events and how to properly position portfolios to take advantage of these market events. He shares a very well thought out and disciplined approach to investing in today's environment. Now, here's the call. All right, Mike, Ryan, thanks guys for taking the time to go through one of my favorite sections of your quarter is getting updated on where we're at with the alternative investments that you guys run. It's always it's an important component of a diversified portfolio for me, because in the update calls that we do, in sort of the general update calls, we're talking about portfolio construction, what your plans are, what's needed in the environment of building a better portfolio for the current economic environment, so that you've got the right tools in place to tweak the portfolio and just make sure that it's always running on all cylinders. That's where the alternatives come in, because in this environment where we're at right now, traditional doesn't always work. And traditional, if you just follow traditional, you're probably going to experience challenges. And so incorporating the alternatives, in my mind, has always been something that's paramount to gaining that portfolio that has decent returns or above average returns without the risk. And I think risk is probably one of the biggest naysayers, or the biggest challenge to portfolios, in that people always say they're comfortable with risk when things are going up, but as soon as things turn, then we start to see the people who were almost lying or didn't get it, that are starting to make bad decisions at a bad time. And so, the importance of bringing alternatives in to mitigate that risk over time, what it does is, in my mind, it just helps people stay invested, which is what's needed for good long-term returns. Jumping in and out has never proven to work, and so that's where the alternatives come in. So I'll pass it over to you, and we'll just go through the alternatives.
Great, thanks, Scott. I always like talking about these alternative investments. We're a big fan of them, obviously, for the right investors. Before I get too far into it, just point your attention to the bit of a legal disclaimer here. I got to go legal on you for a bit, but sometimes I share some personal opinions, and I get quite passionate about the things that we're doing. Not all the things that I'm going to be sharing necessarily reflect the views of Connor Clark & Lund Private Capital, but certainly want to give you the views of the firm, but also myself personally. So just wanted to draw your attention to that.
Great.
Scott, your overview was perfect on why even consider alternative investments. What we're looking to do here is essentially, if you look at a conservative, balanced or growth portfolio, whatever it is, ideally we want to reduce the volatility. There's your risk, there's your return. Move the portfolios up to the northwest quadrant. And if you add alternative investments, here we're showing just 5% real estate, 5% infrastructure, 10% MultiStrategy. Your risk is down and your return is up. And that's a situation where you can have your cake and eat it too. And we do love the benefits that come from these kind of pension style asset classes. OMERS, Teachers, Yale, Harvard, CPP, all of these organizations would have fairly significant allocations to these asset classes, and so that's why we think it's appropriate for us to have it as well. Higher returns, help to manage risk, provide stable income, provide a nice hedge around inflation going up. Good portfolio diversification. These are all reasons that we like to be in that space. MultiStrategy, we've talked about this portfolio in the past. It's something we've covered in the past review. We think it's something where we can deliver 6 to 8% gross returns relative to bonds that might be closer to 1 to 4%, anywhere in that range. But it'll do it with a very similar risk profile to bonds. So it's something that we really like to bring to the table. It's got a low correlation to stocks and bonds, almost zero correlation over time, which makes it a great diversifier for us in the portfolio. And when you look at the impact on that, even if you look at a conservative return target of 5.5% for MultiStrategy relative to a fairly, maybe an aggressive goal of 2% out of core bonds, that's a pretty good risk-return trade-off there. Now, that doesn't mean that this portfolio is always going to outperform bonds. Here you can see when it's outperformed on a quarterly basis from 2011 till now. And when it's underperformed, it certainly has outperformed more than it's underperformed. But what we like more than anything is that it works differently than stocks. It works differently than bonds. So it does provide a source of diversification. Trades every day in the market. It's liquid. Many of your clients, Scott, would be invested in this portfolio, and it's something that we think can add a lot of value moving forward, in particular in the interest rate environment that we're in today.
Sure.
Real estate, I think people get what we're doing there. We're investing in commercial, industrial, retail properties right across the country in high demand, low supply markets. We're ideally looking for properties that are trading at below market rents so that we can buy in on a fairly conservative basis, not overpay for a property, work to add value to bump up the rents over time, and we think that will lead to somewhere in the 8 to 11% gross return range. Compared to stocks at 7 to 9, we think that's quite attractive, and the volatility is about half of stocks. I mean, we should also discuss though that these are private market investments; they don't trade every day in the market, so people do have to understand what they're getting into here because there's a lot of positives, but there are some potential negatives that we just have to make people aware of. Now, you can kind of look through this, and depending on where you live in the country, most of your clients obviously being Ontario-based around the GTA, you can see some properties that might stand out, and you might even recognize, like this one at Spadina and Queen in downtown Toronto. Here's a TELUS building in Burnaby, BC, a bunch of technology buildings in Canada, just outside of Ottawa, a few in Edmonton. This property up in Markham, a newer investment we've made. This is at kind of Caledonia Road in Lawrence, in north end of Toronto, near Yorkdale. You can see a number of different places right across the country here in the industrial market environment. Here's some industrial properties just in Mississauga, Accordion Park Drive. Here's some buildings in Oakville in the Ottawa area. And there's retail outlets that we've also got right across the country. We've got this outlet here in Brantford. There used to be a Zellers in there. We had to talk to Target. Target ultimately decided to pass, and we were quite fortunate for that, I'd say, because we ended up getting Toys R Us, The Brick, HomeSense, and Party City in there, all agreeing to pay about 3 times what Zellers was paying. Some people might know Titan Plaza. That's located in Etobicoke. Blue Mountain Center, if anybody goes up to Collingwood, you probably recognize the Galaxy movie theater and the A&W in there. That's something we own. This is in downtown Vancouver, the Hudson building, where there's a keg in there. The subway is right there as well, for the new local transportation. And this is what's happening currently in the portfolio. We think the Canadian property market will remain strong for the remainder of the year. Certainly Vancouver and Toronto are the most sought after markets. Alberta may experience some renewed interest as oil stabilizes and recovers. And there's a few properties that we have in Calgary, but fortunately, we don't have any commercial in Calgary. We just have one industrial property where Xerox is the major tenant. We've got some retail outlets through the Anthem portfolio, and everybody needs to get food, drugs, and liquor. Fortunately or unfortunately, good times and bad, which will keep regular traffic through those kind of retail outlets. Here's an iconic property that we just bought recently for people's interest, but this is North Toronto Station, the old train station in Rosedale, which is now an LCBO. So we have, essentially the province through LCBO as a tenant. It's the second best producing LCBO in the chain of LCBOs, and the better they do, the more we can charge them in rent. So we think that's a pretty good stable investment. Infrastructure, we're talking about solar projects, Runner River Hydro. We went from not having any interest in solar to being the top solar player in Canada. We're top 5 in North America. We've built 10 schools in Alberta. We're building 2 hospitals on Vancouver Island. We're doing a 40-plus kilometer highway in Regina. We're doing the Calgary ring roads now, starting construction. So we've got aging infrastructure out there. We've got a widening energy gap. We want it to be environmentally friendly. and we've got a Liberal government that's very supportive of the space. So here's the current portfolio in terms of different projects that we've got. A bunch of stuff in BC, Ontario, some Saskatchewan, and we're looking to continue to expand our pipeline of opportunities. We've got a very full pipeline now. You can see credit quality is all very high. If you think about like an A+ at school, well, that's a triple A, a pretty solid A, or A+ here in the AA category. Got a lot of long contract lives, anywhere from 10 to 40+ years. We're still constructing some of these projects, but over 60% are now operational. And one thing we're working on is to get it a little bit more diversified in the traditional space. And recently we've seen some good activity there around the 2 hospitals, the highways in Regina and Calgary. We've kind of talked about this one in the past as a hydro project out in BC. Here's the 2 hospitals we're building on Vancouver Island, in Comox Valley and Campbell River. And recently we just secured the Calgary Ring Road, so that's quite an attractive project. It's going to be a 30-year lifespan where the province of Alberta is willing and able to pay us over that time frame for us to do the heavy lifting on this. So at the end of the day, just in summary, it's all about taking, whether you're a conservative investor, a balanced investor, a growth investor, returns on average should be pretty attractive, but there's also the downside of what happens, 10% of the time, returns could be -7.5 or worse. There's a 40% chance of a 20% decline once in the next 25 years in a balanced portfolio. More risk, more downside, more potential for declines. But if you add real estate, infrastructure, multi-strategy, risk goes down, return goes up. So really that's what it's about from our perspective. And private equity is another opportunity for investors that have interest, and there we'd expect gross returns to be in the 20+% range. But when you look at your opportunity set here and expected returns and risk, things like real estate infrastructure, even with conservative assumptions, are looking pretty attractive, and returns have been closer to 18% out of infrastructure, more like 12 out of real estate for us. So we're not trying to come up with far-fetched numbers here. We're trying to be quite reasonable about it, and we think that multi-strategy real estate and infrastructure could certainly add value to most investors that have an appetite for it over time. Yeah, with that, so hopefully that's a comprehensive summary. If there's any questions, I'm certainly happy to take them, Scott. I don't know if anything's been on your clients' minds, or if we can just leave it at that. And if anybody wants to talk about these things in greater detail, we can always take it offline.
Yeah, no, I appreciate that. Actually, I'm quite happy that you went through sort of a quick snapshot of what some of the, the real estate holdings, because I think it's hard for people to really identify with the actual underlying investments. And, it also speaks to the fact that they are the actual underlying investments. This isn't just something that's investing in a REIT or a pool of somebody else's portfolio. This is a portfolio that's being acquired for the clients of CC&L, and so you can actually see the underlying assets that are being acquired. So it's just nice to have that identification put onto the portfolio. So thanks for doing that.
Yeah, anytime. And so like I said, if anybody wants to talk further about any of this, I think it's been a great quarter. It's been a pretty good year so far. Certainly the one-year numbers are looking better right across the board. But there's always things to be talking about in the markets, good, bad, and ugly. And so if anybody wants to look under the hood and have a more detailed chat, Ryan and I are always available.
Great. Well, listen, guys, thanks so much for taking the time to go through that. Always appreciated. And as always, look forward to our review next quarter. Thanks again. Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment and we'll respond directly online. If you would like to take advantage of a free, no obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.